in continuation with our conversation on mutual funds, let's discuss and debunk some common myths surrounding them.
Yeah, there are so many misconceptions out there, that might be holding you back. Once we clear those up, we'll be in a much better position to make informed investment decisions.
Okay, so let's unpack this.
Mhm.
Imagine someone is interested in mutual funds, but they hesitate because they think it requires, a ton of money.
That's a classic myth. You don't need a fortune to get started.
Okay.
You can begin with surprisingly small amounts,
Okay.
even as low as Rs 500, through something called systematic investment plans or SAPs.
So it's more about consistent, smaller contributions rather than a huge lump sum up front.
Exactly. Think of it like setting aside a small amount regularly, like you would for your daily coffee.
Okay.
With SAPs, you're basically investing a fixed sum at regular intervals, which could be monthly or quarterly, depending on your comfort.
That makes a lot of sense. It feels much more manageable than the image of needing lakhs of rupees just to, dip your toes in.
Right.
What about the myth that you need to be a financial expert to even consider mutual funds?
Ah, the expert-only myth.
Yeah.
This one keeps so many people away from mutual funds.
Right.
The reality is, you don't need to be a financial whiz to invest.
Okay.
Mutual fund companies have entire teams of seasoned professionals who manage the investments.
Oh, okay.
These experts do the heavy lifting, the research, analysis, picking the right stocks or bonds.
Right.
So you can benefit from their expertise without having to become an expert yourself.
So it's like having a dedicated team of financial advisors working for you behind the scenes.
Precisely. They make the complex world of investing much easier to navigate, especially for beginners.
That's a huge relief.
Okay.
Okay, what about the myth of guaranteed returns? Do mutual funds offer a sure-shot way to make money?
While everyone hopes for guaranteed returns, it's important to remember that mutual funds are market-linked investments.
Okay.
This means that their value goes up and down with the market. While the expertise of a fund manager can definitely help navigate those fluctuations, no one can completely eliminate the risk or guarantee a specific return.
So it's not a magic money tree.
Right.
There's always some level of risk involved, but diversification helps mitigate that.
You got it. It's all about finding the right balance for you, and that starts with understanding that mutual funds can be powerful tools for building wealth, but they don't offer a shortcut to riches. It's about informed decision-making and realistic expectations.
All right, next myth. Is financial planning a one-time thing, or is there more to it?
This one's a misconception that could cost you in the long run.
Okay.
It's not a set it and forget it kind of thing. Effective financial planning requires ongoing attention and adjustments because your life changes, your goals evolve, and market conditions shift. You need to regularly review your portfolio and tweak things as needed to stay on track.
So it's not enough to just set up a plan and assume everything will fall into place.
Exactly. Think of it like tending a garden. You wouldn't just plant seeds and walk away, right? You'd nurture them, adjust your approach as the seasons change, and make sure they're getting what they need to flourish.
Here's where it gets really interesting. I've heard that you absolutely need a Demat account to invest in mutual funds. Is that true?
That's another myth we need to bust. While Demat accounts are common these days, they're not mandatory for all mutual fund investments.
Okay.
You can choose to hold physical units of mutual funds, which eliminates the need for a Demat account. But regardless of whether you opt for dematerialized or physical units, the Know Your Client KYC process is mandatory for all mutual fund investors.
So you're saying there's flexibility depending on my preference.
Absolutely. But remember, KYC is a one-time process for mutual fund investments. Once you've completed it, you can invest in various mutual fund schemes without having to repeat the KYC process again and again. This makes it so much easier to diversify your portfolio and explore different investment options within the mutual fund world.
Okay, that's good to know. Now, this one might be a bit specific, but I've always wondered, are mutual funds only for the long haul, like retirement planning?
That's a common assumption, but it's not entirely true.
Okay.
While mutual funds are excellent for long-term goals, they can also be used for short-term and medium-term goals as well.
Oh, okay.
It all boils down to choosing the right kind of fund and aligning it with your individual investment goals and risk tolerance.
So someone saving for a down payment on a home in a few years could potentially use mutual funds.
Exactly. The key is to select a fund that aligns with your time horizon and risk appetite. For instance, if you're investing for a shorter term, you might consider a less risky debt fund.
Right.
On the other hand, if you have a longer time horizon, you might be more comfortable with a higher risk, higher return equity fund.
So there's a whole spectrum of options within the world of mutual funds.
Yeah,
It's not a one-size-fits-all approach.
that's right. And remember, the choice of fund and investment duration should always be based on your personal circumstances and financial objectives.
This is already making me rethink my approach to investments.
Good.
What about the paperwork? Is investing in mutual funds a documentation nightmare?
That's another myth that needs to be debunked. Once you've completed the one-time KYC process, investing in different mutual funds becomes quite straightforward.
Okay.
You only need basic documents like your identity proof, address proof, and a photograph.
Right.
And with so many platforms moving online, much of this process can be completed digitally, making it even more convenient.
That definitely takes away some of the intimidation factor. Now, this next myth is something I've heard a lot, especially from younger people. Is there a certain age you need to be to start investing?
That's a myth we need to shatter right away. The earlier you start investing, the better.
Okay.
Time is your greatest asset when it comes to compounding, and the sooner you start, the longer your money has to grow.
It's like giving your money a head start.
Exactly. Plus, with mutual funds, you don't need a huge sum to begin. You can start small and gradually increase your investments as your income grows.
So there's no need to wait until you're older or have a certain income level to start investing.
Absolutely. In fact, I'd argue that it's particularly important for young people to start investing early, taking advantage of the power of compounding and building a strong financial foundation. And mutual funds, with their professional management and diversification, are an excellent way for younger investors to get started.
I totally agree. It's all about developing good financial habits early on. Okay, final myth for this part of our deep dive. Is it true that mutual funds only invest in the stock market?
That's a common misconception. While some mutual funds focus on equity or stocks, there's actually a whole universe of categories to choose from, including debt funds, money market funds, and even balanced funds, which combine both equity and debt instruments.
So there's a lot more variety and flexibility within the mutual fund world than some people realize.
Exactly. The diversity of mutual funds caters to a wide range of investment goals and risk preferences. Debt funds, for example, invest in fixed income securities like bonds, which are considered less risky than stocks.
So for someone who's more risk averse, debt funds might be a more suitable option.
Precisely. And balanced funds offer a middle ground, combining the growth potential of stocks with the relative stability of bonds. This helps to mitigate risk while still allowing for potential capital appreciation.
This is all making a lot more sense now.
And remember, choosing the right type of fund depends on your individual financial goals, risk tolerance, and investment time horizon.
We've covered so much ground already, busting those common myths that can hold people back from exploring the world of mutual funds.
Don't let those misconceptions keep you on the sidelines. Mutual funds can be a valuable tool for achieving your financial goals. And now that you know those myths aren't true, you can approach investing with more confidence.
Absolutely.
Yeah.
Stay tuned for more insights in the next part of our deep dive.